Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, September 14th, 2021. Pre-recording this Trading Places Live just a bit early, so it's a little before the 9 a.m. Eastern time that you'll be hearing this. But still had some weakness here of late, so we got plenty of things to cover here. And so I'm going to start off by going through that agenda with you. We're going to start off with the daily market recap, go through what happened on Monday. Then we'll get into talking technically, go through some sectors with you there. Then industry groups, number of industry groups, mostly in the consumer discretionary area that I wanted to go through and show you today. And then Max Payne, the Tuesday before Friday options expiration. We always do a Max Payne webinar for our members at Earnings Beats. And so I'm going to go through and I'm going to show you a little bit about what we did last month. And then, of course, invite you to join us tonight if you'd like to become a trial member over at Earnings Beats. Then we'll get into the earnings spotlight and wrap up with the 3 you must see. But before we do any of that, let's go over to earningsbeats.com, where you can get that no-cost trial and join us for tonight's Max Payne event. Simply click there and follow to the join today. So you can take a look at what we offer. We offer a lot of research, a lot of guidance for the market, a lot of trading opportunities. But click on that, and then that'll take you to a page where you can simply scroll down again, see what's covered, and then simply sign up. It is free for 30 days. You will need to give a credit card, but we'll let you know as your 30-day trial is about to expire. We're not going to just quietly sit back and charge you. We want to make sure that you are enjoying the service and intend to stay. And then also, we'll be providing you a great annual rate. That'll help defray a lot of the cost if you do like the service. So anyway, we'd love to have you there. Also, on our homepage, earningsbeats.com, you can scroll down. We have a free newsletter, no credit card required. You can unsubscribe at any time. It's three times a week, Mondays, Wednesdays, and Fridays. Normally, it's a chart of something that looks interesting technically. Could be relative strength. It could be an earnings gap. It could be whatever. We'll talk about that. Try to make it as educational as possible, but also there are plenty of solid trading candidates that are included there as well, if that's what you desire. But again, just go to earningsbeats.com, scroll down, find that free Earnings Beats Digest form here, and then just type in your name, email address, hit the subscribe button. We do a lot of events, and we reach out to our entire Earnings Beats community, including this newsletter. So that's another reason why it's really important to be on this newsletter, is not only to get the 3 articles a week, but also when we do events, especially the free events, we'll send out room instructions to everyone on this list. All right. Let's take a look at what happened on Monday. So here's your daily market recap. Dow Jones Industrial Average up 261 points. The S&P 500 up 10. NASDAQ down 9, almost 10 points. You can see struggling right there at the 20-day EMA. So on a relative basis, the NASDAQ was the only major index that was in negative territory. Mid caps up 16, almost 17 points. Small caps up 10 points. So there are your winners on a relative basis, right up there with the Dow in terms of percentage gains. From a sector perspective, energy was the leader. Off of this recent low, you can see lower prices, higher PPO, positive divergence. Probably about a month ago when we were up near the 20-day here on the XLE near $50, I talked about if we went back down below this level one time down near 46, we would likely print a positive divergence. What I look for when I see a positive divergence is a move up to test the 50-day and a move up, or I should say, or a move up to test the PPO center line. Sometimes you get both. Sometimes you move up a little bit above the 50-day before you roll back over. I mean, we've got some overhead resistance up around 50.5. So wouldn't be surprised, if we do move a little bit up above that. That's going to be the key, though, because I think if you take out that price resistance around 50.5, About that time, you're probably going to see the PPO going positive, and I think that will be a much, much, much more bullish sign for energy. Until then, I'd be a little skeptical on this move up to the 50-day. We'll see whether or not we can sustain it. My guess is we don't, but we are in a secular bull market. A secular bull market tends to take every area up on an absolute basis. What I don't expect is for energy to lead the market on a relative basis. So could we get through 50-50? Yeah, I mean, I'm not looking for it just yet. I need to see the market do it, but I'd be more inclined to follow the relative strength, which I don't think you're going to see a whole lot of from energy, just my opinion. Financials also had a strong day on Monday, rising more than 1%. We've got some pretty good gap support down here in the 37.5 range. Got the 50-day moving average at 37.36. So that's quite a bit of support that I'd be looking for. If you look at the XLF on the last high, we had a negative divergence, which is opposite of what we saw in energy, where we had a positive divergence. Lower lows, higher PPO, higher highs, lower PPO. So we're looking for this to come down to the 50-day, possibly to the center line. So you can see it works both ways. Divergences are really important just to give you an indication of slowing momentum. They don't guarantee us anything, but there are certain things that I do look for when I see negative divergences. Just want to realize that there's more risk. If you're on the long side and you have a negative divergence, there's more risk to the downside. If you're shorting and there's a positive divergence, there's more risk to the upside. So we'll see where they both go from here. Real estate also up a little bit, about 0.5% yesterday. It pulled back, testing an area of support. I'm going to call it right around this 46 to 47 area. Closed at 47.11 on Monday. We'll see where we go from here. We are in an uptrend, though. I was looking for real estate to pull back off of a 60-minute negative divergence. We've gotten that. So I think this area is free to go wherever at this point. I think it depends a lot on what happens with the market. Max Payne coming up, the options expiration Friday. Industrials looked like it was breaking down intraday yesterday, managed to rally back, hold this 102 level. So at least in the short term, industrials, which gained 0.25% yesterday, this group does look pretty good. Healthcare was the worst performer, but if you notice, 4 or 5 days ago, maybe even 6 days ago, we were attempting a breakout with a much lower PPO. So we had been holding that 20-day, but you see that negative divergence. You start thinking 50-day. Well, guess what? That's where we are. We literally finished almost right on the 50-day, testing this area of price support here at about 131.75, something like that. We did bounce off of that low, came back up, closed 132.37. PPO, excuse me, working its way back to the center line. All right, let's move on to talking technically. Actually, before we move on to talking technically, let's talk just a little bit here about the 10-year Treasury yield. Later this morning, and by the time you get this recording, August CPI will be out. It's out at 8:30 Eastern. It's expected to rise 0.4% for August, the headline number for CPI. July was up 0.5%. So we're expecting it to pull back a little bit. August core CPI expected to rise 0.3%. July was also 0.3%. So we're not looking for a lot of change from July. If anything, maybe it were to tick down, but that's not been the history in 2021. 2021, the history's been inflation's been hotter than expected. So we'll see whether or not, or we'll see where we come in there. Currently this morning, we haven't opened yet, but we've got 1.324. That's the yield on the close from Monday. I'm still watching up here around 142, 143. What I would worry about is if inflation numbers come out hot, yields soar, and at the same time, growth stocks take a hit on a relative basis. That would tell me that the market is more concerned about inflation. Now, if inflation numbers come out hotter than expected and the bond yield doesn't go up and growth stocks perform okay, then the market's telling us don't worry about inflation. And that's what I always say. It's not that I don't pay attention to the news. I always look at the news, the economic news and so forth that comes out. But it's the reaction to the news that's the most important, because that's telling me what collectively how Wall Street is deciphering the news. And so it's always about the charts for me. Yes, I'm going to know what's going on with the news, the economic news, especially earnings news, but it's more about how everything is reacting. The stock market, the bond market, the relationship, the intermarket relationships. That's what you really need to focus on, in my opinion. All right. So now let's move on to talking technically. And the first thing I want to show you, this is a chart of the CPI index. So it's not just stocks and ETFs and indexes, stock indexes and so forth that you can track its stock charts. Here's the consumer price index, dollar CCPI, consumer price index core. Now I can get rid of the 1C and just CPI, and that would just be your headline number. But I like following the core because this is primarily what the Fed's going to be looking at. Now, what you can see is the the CPI moving up pretty consistently throughout this century. You see there's one little red blip. I don't know if you can see it on your screen, but there's one little red blip where the CPI goes down in 2008 and also at the end of 2009. Then one little blip here in the beginning of 2017. And then for the first time in 2 decades throughout, this century, we had 3 down months in a row on the consumer price index core CPI, 3 in a row. Now, part of what we're looking at when we go into 2021 is you're looking at prices this year versus last year. Well, you've got to keep in mind that we went down last year. So, which is very, very unusual. And we're playing catch up now. This is where you got to understand how the economy worked through the pandemic. We shut down the economy. The supply chain was basically cut off for a while because there was nobody buying anything. The economy was shut down. So as a result, factories shut down. We had really no supply being created or very little. And now all of a sudden we're moving into 2021. We're trying to come out of this pandemic, even though the Delta variant persists. But we're trying to break out more and more areas of reopen. I mean, now obviously we're doing a lot more in terms of the airlines than we were a year ago, and that's one of the hardest hit areas. But things are picking back up. Well, they're picking up at a time when the whole supply chain was disrupted. And so I think that there's this little bubble that went to the downside that's now coming back up through the upside. And we're seeing this temporary, and this is what I believe the Fed is referring to when they talk about, inflation issues being transitory or temporary. I think this is, and I'm going to annotate this for a second because what I see, if I just, pull up we'll do a blue dotted line here. But I mean, if you just draw this right in through here, you I'm just trying to do maybe like the middle, where we have just as much upside, movement above the line as we do below. So it's kind of like this midpoint that I'm trying to draw through here. So you see how with the pandemic, we took this hit and stayed below for a year. Well, now we're catching up. And it's kind of like this bubble going through a water hose or something, So what I'm expecting is we're going to get to a point probably sooner rather than later where we're going to start to see things leveling off in terms of the CPI. Maybe it'll be longer than I expect. Maybe it'll be 6 months from now. I don't know. But at some point, what I expect is going to happen is we're going to see this revert back down toward this blue dotted line. And that's, I think, what the Fed's expecting. And when it does this over a period of a year, we're going to see almost no inflation. And it's because all this upward pressure in wages and in prices because of the lack of supply. I think next year we're going to have oversupply. I think we're trying to catch up and we're trying to do so much. I think it's going to be a combination of supply building and all of a sudden the demand, which was so strong, I think it'll still be good and solid, but I don't think it'll be quite what we saw coming out of the pandemic. And so that combination, I think, pulls this line back toward the blue dotted line. Just my opinion. And I also think that's going to create some problems for the market next year. Stock market. We'll see. And I'll keep you posted on that. But down at the bottom of this chart, which is pretty interesting, I pull it up on a monthly basis and then I change the candlestick to a line chart so you can kind of follow it each month. But on a monthly basis, it only comes out once a month. So putting it on a daily chart makes no sense. Put it on a monthly chart. And then down here, I have a 12-month rate of change. So you can see what inflation's doing on the annual basis. This is what's got everybody up in arms. But I think it's the supply chain disruption and all of a sudden surging demand coming out of the pandemic. I think it's temporary. I think, like the Fed, it's temporary. We'll find out who's right. Because there are a lot of people who do not agree with the Fed and believe this is starting a period of massive inflation. That's why I say we'll see who's right. I don't believe that's the case. And that the market's not trading like it's the case. Growth stocks should be getting pummeled, and they're not. All right. So also, let's take a look at a couple of sectors real quick here. So we've got the XLE. This is the energy group. And there's your 50-day test. Here's that positive divergence I was talking about. There's your lower low, higher PPO, and there's your move back to test center line. We're back to test the 50-day. Here we're moving up near the center line. And as far as I'm concerned, and I always talk about this, I wrote an article about it. Every technical indicator out there, to me, takes a backseat to price support and resistance. So here we broke down below this low, went back up. That was your reaction high. So broken support becomes resistance. Now we go back and we've taken out this low. So this is a lower low, lower high, lower low. I think we got to get back through this high. So I think 50, or let's get out of this and I'll tell you the exact number. I think on the XLE, the number you really need to be watching is $50.35. I think if we close above 50.35 on the XLE, then I think we're probably looking at more upside action on an absolute basis. Now, that's different than on a relative basis. So if we pull this up versus the S&P 500, and we go to a line chart and pull this up, you can see, I mean, we're downtrending, and this downtrend has been going on. I'm just going to pull up 5 years, but we've been going down and down and down and down. So the path of least resistance here on a relative basis is down. This is why, even if we start to strengthen, I believe the S&P 500 is going to go higher later this year. So even if the XLE goes up, it's going to be kind of what we've seen over the past few months. I just think the relative strength is not going to be there. So that's what I would be kind of watching for. Also take a look at materials, energy and materials. Materials, I think, looks better than energy on an absolute basis. I think we've still got, here's your triple top, higher high, here's your higher low. And so I just think we're range bound. I'm going to say 88 and change to the top side, all the way down to about 79 to the downside. We're sitting in the middle at 84. So this one I think looks better on an absolute basis. Relative basis, I'm still not a fan. And you can see that if we pull this up and change this back to excuse me, line chart. Look at what's going on a relative basis. Materials on a relative basis actually, I think, worse than energy. We're down near 52-week low. And just like energy, it's in a long-term relative downtrend. So I think you just got to be a little careful there. All right, let's move on to industry groups. I just wanted to point out some industry groups I think look kind of interesting. The first one, I wrote about this to members yesterday in our daily market report. But here, I'm going to show you what I think is a pretty key area of trend line resistance. So it's going to be right about in there. Let's drag this down. So if you connect all of these tops, 1, 2, 3, 4, 5, maybe even 6, that would be a sixth one. 7, you can see that there's been quite a downtrend in play. And I didn't put this in the DMR, but you've had this squeezing triangle for a while. Looks like we made a breakout. Now you've still got overhead price resistance that we've got to, deal with, because trend lines, I mean, the problem with trend lines is they're very subjective. So we're breaking out of this trend line, but what if we drew the line from here and we went to here? Let's say we go right back down from here. Well, there's a top, here's a top, and then this would be a third top. This could be another trend line. So trend lines are very, very subjective, but I have to admit, I do like trend lines when they hit 5 or 6, 7 different points. I mean, to me, that's pretty powerful to see this start to break to the upside. So at least be aware that renewable energy is starting to look better technically, because when this group moves, I mean, we've seen it. Look at what happened last year. I mean, here it was down at 130 in September, and by February, it was 420, more than tripled. And then went from 420 back to 180 in 3 months, lost 60% in 3 months. So when this group moves, it moves, and it's been beaten up for a while. Just beware. It looks like it's breaking out from above that squeezing triangle. All right, next up, the media agencies group. I just want to bring this up, annotate this one to show you a key area of support. If you look at where we just closed recently, look at that low, this low, this low, this low. Number of tests of this support line. So we've been trending lower. Just beware. Just beware. 705. If you start seeing this trade into the 600s, that's not a good sign for this group. So an area to watch on a industry group. Now for a couple of discretionary groups I wanted to show you. So let's take a look at hotels. Hotels, I know, you look at it and you just kind of get frustrated because they're going nowhere for a long time while the market goes up. But what you have to keep in mind, you got to look at the bigger picture and keep everything in perspective. When you make big moves to the upside, like hotels did, we went this double bottom 1600 to 2600. We went up 1,000 points, more than 60% in 4 or 5 months. So consolidating for a period of time is okay. Look at where we broke out and moved up in basically 4 days from 2250 to 2600, 4 days. And it took us 1, 2, 3, 4, 5, 6, 7 months. Well, 5 months and then 6 months, basically go back and retest it. But this is your key support level. A lot of folks upset with hotels. We're losing momentum. PPO's in negative territory. You've got all these moves below the moving averages, blah, blah, blah. What's the most important thing? Price support. It held. Nothing wrong with what's going on right now, in my opinion, in hotels. I think we are simply sideways consolidating, and when we break out, it's probably going to be another swift move to the upside. And I believe we are going to break out in this group. Just my opinion. How about gambling stocks? We had such a surge last month, and it really started with options expiration. I'm going to talk about Max Payne in just a minute. But look at this move on gambling stocks right here at 750, testing these lows right here, effectively testing these lows, these highs. That's kind of the price support area, I would say, 750. But we moved up, and in its first sign of an uptrend, it successfully defended that rising 20-day EMA yesterday. I thought that was a really good bounce on gambling stocks. Now, if you do fall back below the 20, I'd watch the 50, and I'd also watch this price support on the latest breakout. If you're going to make an argument that and I could even maybe draw it right there with this high. These are 2 key highs over the last 2 or 3 months. And so we broke right through with great volume. So these are 2 levels to watch the downside, along with the 20, along with the 50. If we lose all of that and break back down to the downside, it would seem to me we're going back to 750 and probably going to break down. I don't think that's going to happen. I think at the worst, if September weekends, maybe we get back down to about that 810, 815 area. That would be worst case in my opinion. I'm looking for it though. Positive test. I think we could see another breakout in the gambling area. Let's look at restaurants. So I think off of this move up here, 6 days in a row, great breakout. I think this could be a little cup. Looks like a nice little rounded bottom. We're moving back up, trying to get through 2,600. If we do, I think 2,650 is next. And I think we could easily print this cup. So I think off the uptrend on an absolute basis, I think restaurants look pretty good here. Last one I wanted to show you is footwear. So footwear right now, I mean, I'm a fan of footwear. I think that we're going to go higher. Short term, however, don't like this failure at the 20-day and breaking to a new low. I think, again, keep in mind the key areas of support. I'm going to say the biggest on the chart is right there where we gapped up. This is when Nike came out with their report and gapped up, footwear took off. That top of gap support on this kind of volume is usually very strong. So if the market weakens second half of September and you get footwear down under 2,800, I think this is an area I'd be looking. Obviously, Nike would be one stock I'd be looking at, Crocs, maybe even Skechers. Let me just show you a quick little chart on Skechers testing its recent support area. I actually bought a little bit yesterday, just full disclosure. And we'll see whether or not it holds. Doesn't hold, I'll be getting out. But there's your price support level. And you can see we came right down there and tested yesterday. And then also right here is gap support. So I'm going to say 44.5 to 45.5 is a major area of support. The stock was at 56 a month and a half ago. Now it's 46. Could be an opportunity. Could be that it's rolling over and going to break down. But I think we've got some really good support here. And I placed my bet, even though it was a smaller than normal position. And the reason it's a smaller than normal position is we're going into the second half of September. And that's one thing I've been saying, just to maybe be a little more cautious in your trading. If it goes up, fine, I'm making money. If it goes down, I've got a smaller position than normal. Yes, I lose money, but I'm not going to lose much. And that's the way I would approach the market right now. All right, let's move on to Max Pain. So I wanted to show you a little bit about what we do for Max Pain, because we do have a big event. We're going to have to move through this very quickly. But go back and look at my What You Need to Know About September Weakness Chart Watchers article. And what you'll see is that right around the middle of the month, near option expiration, that's where we almost always see weakness in the market, especially if we've had strength going into the week. So this month's a little bit different because we've been going down heading into option expiration week. But still, I think this is an article worth paying attention to. And what I did is, I'll go through and I'll show Max Pain, which is the point at which in the money calls equal in the money puts. That's where market makers make the most money. And so Max Pain in August was at 431. We were up at about, when we had our webinar, we were about 445. We went down into the mid 430s. And what I always say is Max Pain is a directional clue. That's it, directional clue. So don't, reach too much into it. I want to show you one stock though. Here's a stock that had been beaten up mercilessly to the downside. And there was a lot of in the money puts. Stock was trading down here at $24. Max Pain 27.88. Look at where this stock went over the next 3 or 4 days. Right back up to the Max Pain level. Wiped out all that net in the money put. If you own puts, you saw them, a lot of them, the value completely vanished. That's what we talk about. So make sure you stop by at Earnings Beat, sign up, and come to tonight's Max Pain. Love to have you. All right. Only thing I had for earnings was I wanted to show you Oracle this morning. So if we pull up Oracle, the stock is down 2%. They did beat on their bottom line, but they missed on their top line. So going to start off a little rough today, probably back below the 50-day. Let's see how it trades after that. And then for the 3 you must see, let's wrap this up. I'm just going to do a very quick Apple, Ford, and AAL. Apple pulling back to the 50-day. I think this one looks pretty good. Watch support around 144, 145. Ford, been trending lower, can't get back through that 20-day. That's going to be your first test. Let's get through the 20-day and then up around 1340, a little bit of resistance. And finally, to wrap up, AAL, American Airlines, same thing here. Double top, 50-day moving average. Got to get through about 20.5 here. All right, thanks for joining in. Remember to join me tomorrow over at earningsbeats.com for your next Trading Places Live. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.